What's up, everyone? Brand the Mortgage Man here, and today I'm going to help you prepare for your home buying journey. I've helped more than 10,000 home buyers over my 20-plus year career, putting them at the top 1% of loan originators nationwide. And it's with this experience that I've determined that whether you're a first-time buyer or a seasoned investor, there are 7 key steps you should understand when planning to purchase a home. In this video, I'll explain each of these in detail and why these steps are crucial for a successful home purchase. So let's start off with step number 1. If you're not planning to pay cash for a property, you're going to need financing. And that financing is going to come from a bank, a mortgage broker, or a lender. So the first step, if you're planning to buy real estate, is determining whether or not you qualify for financing for that real estate, because this is going to help you determine the price point in which you should conduct your home search. So first, you need to find a lender. You can do that by getting a referral from a friend or family member, coworker that might have worked with someone that they were happy with. You can go online and conduct your own research. Go on Zillow.com, search mortgage lenders in a specific area. Let's call it Florida. And you'll get the top loan officers based on reviews that you can work with. And from there, you can make your decision by calling around, shopping around, finding out who's going to best suit your needs and best fits what you're looking to accomplish. But once you find the right lender, you're going to want to go through the mortgage pre-approval process. This is where the lender is going to collect all of the information necessary for making a decision on getting you approved for a mortgage. This has to do with your income, your employment, your assets, meaning money that you have available to use for the purchase, your credit, which will be determined with a credit pull. And from there, they'll be able to let you know what price point you should be looking in and the type of mortgage that's going to best be suited for you, whether it's conventional, FHA, VA if you're a veteran. All of those things will be determined when you speak to the lender. That lender will also let you know, or they should at least, let you know if you qualify for any sort of special programs that might be available to use toward your down payment, right? There are grant programs, bond programs, there are state-specific programs that can help you cover a portion, if not all of your down payment on the property. And if you want to know how to find those types of programs, if maybe you're not getting that information directly from the lenders you're speaking with, make sure to check out my video that talks about how to find down payment assistance programs. They're also known as DPA, and subscribe so you get more great information like that. But step 1, finding out who your lender is going to be and securing your financing for the purchase. Step 2, after you've secured your financing and determined who your lender is going to be, you want to find a realtor. I never recommend trying to find a property on your own. You want to find a realtor who specializes in the area which you're looking so they can help find the right property for you. You're going to let them know exactly what you're looking for, price point, bedroom, bath count, the city, or maybe the specific school zone you want to be in. Maybe you have children and you want to be able to send them to a specific school, right? The school zone is going to matter in those situations. But a realtor is going to help you find those proper houses that are going to meet your needs, because the thing is, you likely have your own job, right? How much time do you really have to spend looking for a home? A realtor who does it full time, and that's a question you can ask when you're interviewing realtors, right? Is, do you do this full time? Because you want a realtor who does it full time. You don't want it to be someone who has a day job and then does real estate on the side. They're not going to be able to give you the level of service that you really need in a market where it's more and more competitive every single day. You want someone who does this full time, and you can actually do it the same way that you found your lender, right? If you don't have a friend or family member or coworker who can refer you to a real estate agent that they recommend, you can also use a website like Zillow.com, read reviews from other individuals who have used the realtors, and you can decide based on that who you want to work with. You can interview more than one realtor, see who's going to best fit for you, right? They might have great reviews, but maybe they're just not the right fit as far as, rapport. Right? You don't necessarily feel like you're going to get along with them, especially if you're going to be driving around with this person to go find homes. You want it to be someone that you enjoy spending time with and that does a great job, right? So step 2 is finding the right realtor for the job, right? How many homes have they sold in the last year, right? That's an important question. Their experience is going to be extremely important in determining what your experience is going to be like. You don't want someone who's brand new to the business. And if you are okay using someone brand new to the business, make sure they have a support system behind them, like a team that can give the support needed to help with things like negotiating and preparing the contract properly, giving you insight on the best approach to submitting an offer on the property. Those things are extremely important, and that's why you want to work with a buyer's agent and not necessarily go directly to the listing agent, which is the person representing the seller on the property. You want someone looking out for your best interest, which would be your buyer's agent. Now, once you find that agent and you go and you find the right home, right? You're gonna need to make an offer on that home. So what does that mean? It means that you're gonna write up a contract with your real estate agent based on the terms you've previously discussed with them. Maybe their asking price for the property that you find is $400,000, but you and your realtor decided that based on comparable sales in the area, an offer of $390,000 makes sense. Well, you're going to draw up your contract to make the offer at $390,000. You're also going to determine how much of a deposit you want to give initially, because when you go under contract on a home, you have to give something called an earnest money deposit. This isn't your total down payment on the property, but it is a dollar amount that has to be held by the title company handling the closing of the transaction, and it's held there up until the day of your closing, and at that time it's applied toward the total money needed for the purchase. It's your earnest money deposit. It shows the seller that you're serious about buying their home because you have some skin in the game, that you're putting at risk, because part of the offer you make on that property within your contract, you're going to have contingencies. One of those contingencies, if you're getting a mortgage, is going to be a finance contingency. And the contract calls for 30 days here in Florida, but to be competitive, you really need to shorten that time frame down because most closings are taking place in 30 days or less, and no one wants to stretch out the loan approval period all the way to the last possible day. So in most cases, you're going to see a 14 to 21 day loan approval period, but that's a contingency that you and your realtor are going to want to talk about. But assuming you have that in there, that earnest money deposit I was referencing becomes at risk if you go past that loan approval date in this example and you're unable to obtain financing. You can lose your deposit. Sellers like to see that you're giving a deposit because, like I said, you're putting skin in the game. You're taking risk the same way they're taking risk by taking the property off the market if they accepted your offer. So you're making the offer on the home. Make sure all of the terms are what you and your realtor discussed and what you agree to, and of course, what you're comfortable with on that. Now, let's assume that the seller receives that offer, maybe you negotiate back and forth a little bit, and you go under contract officially. This means that the seller accepted the terms and you accepted the terms from the seller to purchase that property. Now you're officially under contract on the home. You have a set closing date. Now you have a window of time that you need to accomplish everything: obtaining your financing, having your home inspection done. Your lender's gonna order an appraisal on the property, right? All of these things take place once you're under contract. So that starts with the home inspection, which is step 5. A home inspection is not a requirement, but it is something you wanna have done because it's gonna look for underlying issues with the property. Of course, there's gonna be surface level issues as well, but it's gonna look for things with the roof, the AC system, the electrical system, things that are really high dollar items if there were an issue to arise either now or in the near future. So you want these things to come to light during the inspection period. In your purchase contract, that would have been one of the time frames you negotiated. 15 days is what's automatically called for in a Florida contract. However, to be competitive, you're looking at 7 to 10 days for the inspection period. So you have your home inspector come out. The inspection's also going to be needed for you to get an accurate quote for homeowners insurance on the property, specifically a wind mitigation and 4-point inspection, right? That's going to allow the insurance agent to give you an accurate quote when it comes to the policy premium, because if you're going to get a mortgage on the property, as most people do, you're going to be required to carry homeowners insurance, right? So just keep that in mind. So you need to have a home inspection done. You want to have that done within the first 7 days that you're under contract on the property. Now, while your inspection is being done, your loan is with your lender and it's going through the underwriting process. The underwriting process is where you've now provided a home to go along with all the other information you previously provided to get pre-approved, right? We already looked at your income documents, your asset documents, your employment, your credit history. Assuming none of those things have changed, you're not going to have any issues there because it was done properly up front. But now you're adding a home or collateral into the mix, right? So that's step 6, the home appraisal. So your lender, as part of the underwriting process, is going to order an appraisal on that property. Now, although you've agreed in our example to pay $390,000, let's just say, for this property, the property still needs to appraise for $390,000. Just because you're willing to pay that amount doesn't necessarily mean that it's worth that. Now, if you're working with a good agent, right? Step 2, you found a really good agent. They pulled comparable sales in the area to help determine that $390 was the right offer. Well, then you shouldn't have anything to worry about. The appraisal should match what you're paying for the property or potentially even come in higher than what you agreed to pay for the property. But there are times during the home appraisal where it comes in lower than what you agreed to pay. And when that does happen, it's your realtor's job to go back to the seller and their agent and try to negotiate the price down for you. Now, if the seller and their agent in these instances feel that the home is worth the 390 and they can provide comps or comparable sales that the appraiser hasn't used in the report that they feel support the 390 purchase price, just in this example, well, then we as a lender can appeal the report, provide that information, and if the appraiser agrees that, you know what, these are better comparables than what I already used, well, they'll adjust the value, right? But in most cases, the value does not get adjusted. And if it appraises low, well, now you need to either cover the difference between the value of the property based on the appraisal and the contract price, or the seller needs to come down to the appraised value, because lenders will always lend on the lower of the appraised value or the contract price. They will not lend you more money than the home is worth or based on a value that's higher than what the appraisal is telling you, right? Just because your contract price is 390, if the property is for 380, the lender's not going to lend based on 390. So just keep that in mind. Step 7, you've made it past all of that. You provided anything necessary to get your loan clear to close by the lender, which means that they've updated everything. You've provided insurance. The appraisal is good at value. Any updated income documents, asset documents were already provided. The underwriter for the loan signs off on this, and now you're closing on the home. So on closing day, you're going to go to the title office, or they may come to you, and you're going to sign all of your paperwork. You want to make sure all of the mortgage documents match the terms you initially agreed to with your lender, because at the beginning of the process, once you went under contract, you signed an initial set of loan disclosures. Well, now at the time of closing, assuming nothing changed during the process, you didn't decide to change your interest rate, your loan amount didn't change, or you didn't have to adjust anything. Well, the documents that you sign at the time of closing should match what you signed at the time you went under contract and you got your initial loan disclosures from your lender. So you want to review those in detail, make sure it's accurate. You're going to wire any remaining balance needed for closing to the title company or title attorney handling your closing, right? So I talked about you're going to give an earnest money deposit early on when your offer is accepted. Well, you still have to bring the balance of what's needed for closing. If you needed $20,000 in total for your purchase and you gave a $5,000 earnest money deposit, you still owe $15,000, right? The total of $20,000 minus the earnest money deposit, what's left is what you still need to wire for closing. So you wire that to the title company, typically the day before closing, so that the money's already there and waiting once you close. But assuming everything matches as it should, it's rare that it would ever be different on the final documents than it was early on in the process when you started with your lender and went under contract. Well, you'd be moving forward and closing on your home. And at that time, your lender sends the mortgage money to the title company as well. It gets combined with your money, and the funds are released to the seller of the property so that they can give you the keys to your new home. And then going forward, you'll start making mortgage payments on that property. Like we said, assuming you got a mortgage and you are now the owner of a home. So it's very important to understand these steps. And by understanding these 7 steps, you'll be ready to make an informed decision and achieve your homeownership goals. And if you find this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages. And make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.